Cryptocurrency has taken the world by storm, offering new opportunities for investment and innovation. But with these opportunities come significant risks that every investor and enthusiast should be aware of. In this video, we'll explore the various dangers associated with cryptocurrencies, from market volatility to security threats. Understanding these risks is crucial before diving into the world of digital assets. Let's begin by looking at why cryptocurrencies are considered risky and what makes them different from traditional investments. As we move through each scene, you'll gain a clearer picture of the potential pitfalls and how to navigate them. One of the most well-known risks in cryptocurrency is extreme market volatility. Prices can swing dramatically within minutes, making it possible to gain or lose large sums of money very quickly. Unlike traditional stocks or bonds, cryptocurrencies are not backed by physical assets or government guarantees, which means their value is largely driven by speculation and market sentiment. This volatility can be exciting for traders, but dangerous for those unprepared for sudden losses. Understanding how quickly prices can change is essential for anyone considering investing in crypto. Another significant risk is the lack of regulation in the cryptocurrency market. Unlike traditional financial systems, cryptocurrencies operate in a largely unregulated environment. This means there are fewer protections for investors, and fraudulent activities can go unchecked. Without clear rules and oversight, scams and market manipulation are more common. As a result, investors must be extra cautious and conduct thorough research before participating in crypto markets. The absence of regulation also means that legal recourse is often limited if something goes wrong. Security is a major concern in the world of cryptocurrency. Digital wallets and exchanges are frequent targets for hackers, and once funds are stolen, they are often impossible to recover. Unlike banks, which can sometimes reverse fraudulent transactions, crypto transactions are irreversible. This makes it essential for users to take strong security measures, such as using hardware wallets and enabling two-factor authentication. Even with precautions, the risk of cyber attacks remains high, making security a top priority for anyone involved in crypto. Cryptocurrency space is unfortunately rife with fraud and scams. From fake initial coin offerings, ICOs, to phishing schemes and Ponzi schemes, there are many ways for unsuspecting users to lose their money. Scammers often take advantage of the lack of regulation and the anonymity provided by blockchain technology. It's important to be skeptical of offers that seem too good to be true, and to verify the legitimacy of any project before investing. Staying informed and cautious is the best defense against fraud. In the world of cryptocurrency, your private key is the only way to access your funds. If you lose your private key, you lose access to your assets permanently. There is no central authority to help recover lost keys or reset passwords. This risk highlights the importance of securely storing your private keys, whether through hardware wallets, paper backups, or secure digital storage. Losing a private key is one of the most common and devastating mistakes in crypto, so always take extra care. Like traditional banking systems, cryptocurrency transactions are irreversible. Once you send funds, there's no way to get them back unless the recipient agrees to return them. This can be a problem if you make a mistake, such as sending funds to the wrong address or falling victim to a scam. Always double-check transaction details before confirming, and be aware that mistakes can be costly. The finality of crypto transactions is both a strength and a risk, so caution is essential. Legal status of cryptocurrencies varies widely from country to country. In some places, crypto is fully legal and regulated, while in others it is banned or restricted. This uncertainty can create risk for investors, as laws and regulations can change rapidly, affecting the value and usability of digital assets. For investing, it's important to understand the legal environment in your country and stay updated on any changes that could impact your holdings. Traditional financial systems offer various consumer protections, such as insurance for bank deposits and regulatory oversight. In contrast, cryptocurrencies generally lack these protections. If an exchange is hacked or goes bankrupt, users may lose their funds with little chance of recovery. This lack of safety nets makes it crucial for users to choose reputable platforms and take personal responsibility for securing their assets. Always research exchanges and wallets before trusting them with your money. Cryptocurrencies can be technically complex, requiring users to understand concepts like wallets, private keys, and blockchain technology. This complexity can lead to mistakes, such as sending funds to the wrong address or falling for technical scams. For newcomers, the learning curve can be steep, and errors can be costly. Taking the time to educate yourself and seek reliable information is essential before getting involved in crypto. Don't rush into investments without understanding the basics. Many cryptocurrencies face scalability challenges, meaning they struggle to handle large numbers of transactions quickly and efficiently. This can lead to slow transaction times and high fees, especially during periods of high demand. Scalability issues can limit the usability of certain cryptocurrencies and impact their long-term adoption. Developers are working on solutions, but for now, users should be aware that network congestion and delays are common risks. Some cryptocurrencies, especially those using proof-of-work consensus mechanisms, consume large amounts of electricity. This has led to concerns about their environmental impact, as mining operations can contribute to carbon emissions and energy waste. While some projects are moving toward more sustainable models, environmental risks remain a hot topic in the crypto space. Investors should consider the ecological footprint of their investments and support projects that prioritize sustainability. Pump and dump schemes are a common form of market manipulation in the crypto world. In these schemes, the price of a cryptocurrency is artificially inflated through misleading information, only for the organizers to sell off their holdings at the peak, leaving other investors with losses. These schemes are often coordinated through social media and online forums. Being able to recognize and avoid pump and dump schemes is essential for protecting your investment. Cryptocurrency exchanges are another risk to watch out for. These fraudulent platforms may look legitimate but are designed to steal users' funds or personal information. They often use sophisticated websites and marketing tactics to lure victims. Always verify the legitimacy of an exchange by checking reviews, regulatory status, and community reputation before depositing any money. Using well-known and established exchanges is the safest option. Phishing attacks are a common threat in the crypto world. Scammers use fake emails, websites, or messages to trick users into revealing their private keys or login credentials. Once they have this information, they can steal your funds instantly. Always be cautious with unsolicited messages and double-check URLs before entering sensitive information. Using security features like two-factor authentication can help protect against phishing. Rug pull is a type of scam where developers abandon a project and run away with investors' funds. This is especially common in decentralized finance, DeFi projects, and new tokens. Rug pulls can be hard to spot as scammers often build hype and trust before disappearing. To avoid falling victim, research the team behind a project, check for transparency, and be wary of projects promising unrealistic returns. Cryptocurrency wallets are designed to steal your funds or private information. These apps may appear in official app stores or online, mimicking legitimate wallets. Once installed, they can compromise your security and drain your assets. Always download wallets from official sources and verify their authenticity before use. Checking reviews and community feedback can help you avoid fake wallets. Any cryptocurrencies are built on new and untested technologies. Bugs, vulnerabilities, or design flaws can lead to unexpected failures or security breaches. Investing in projects with unproven technology carries additional risks, as problems may not become apparent until after launch. It's important to assess the maturity and track record of a project's technology before investing significant funds. Cryptocurrency projects often rely heavily on their development teams. If key developers leave or lose interest, the project may stagnate or fail. This dependence can create uncertainty and risk for investors, especially in smaller or newer projects. Before investing, consider the stability and commitment of the team behind the cryptocurrency, as well as their track record in the industry. Governments around the world are paying closer attention to cryptocurrencies, and regulatory crackdowns can have major impacts. New laws or enforcement actions can restrict trading, ban certain coins, or require exchanges to shut down. These changes can happen suddenly and affect the value and accessibility of digital assets. Staying informed about regulatory developments is essential for managing this risk. Cryptocurrency transactions can create complex tax situations. In many countries, buying, selling, or trading crypto is considered a taxable event. Keeping accurate records and understanding your tax obligations is important to avoid legal trouble. Tax laws regarding crypto are evolving, so it's wise to consult a professional or use specialized software to manage your crypto taxes. Liquidity refers to how easily an asset can be bought or sold without affecting its price. Some cryptocurrencies have low liquidity, meaning it can be hard to sell large amounts without causing price drops. Low liquidity can also make it difficult to exit positions quickly in volatile markets. Before investing, check the trading volume and liquidity of the cryptocurrency to avoid getting stuck with unsellable assets. Forks occur when a blockchain splits into two separate chains, often due to disagreements among developers or the community. These splits can create confusion, duplicate coins, and technical issues. Forks may also impact the value and security of the original cryptocurrency. Staying informed about upcoming forks and understanding their implications can help you manage this risk. Software bugs are a risk in any technology, and cryptocurrencies are no exception. A single bug in a wallet, exchange, or blockchain protocol can lead to loss of funds or security breaches. Developers work hard to find and fix bugs, but no system is perfect. Using well-established software and keeping it updated can help reduce the risk of bugs affecting your assets. Some cryptocurrency projects lack transparency about their operations, finances, or development progress. This can make it hard to assess the true value or risk of an investment. Projects that are not open about their team, code, or business model should be approached with caution. Transparency is a key indicator of trustworthiness in the crypto space. Cryptocurrency exchanges can fail for a variety of reasons, including hacks, mismanagement, or regulatory action. When an exchange fails, users may lose access to their funds, sometimes permanently. To reduce this risk, avoid storing large amounts of crypto on exchanges and use personal wallets whenever possible. Research the reputation and security measures of any exchange you use. Counterparty risk arises when you rely on another party, such as an exchange or lending platform, to hold or manage your assets. If the counterparty fails or acts dishonestly, you could lose your funds. This risk is higher in unregulated or new platforms. Always assess the trustworthiness and track record of any service you use to minimize counterparty risk. While cryptocurrencies can offer privacy, not all coins are truly anonymous. Some blockchains are fully transparent, meaning transactions can be traced. This can expose users to privacy risks, especially if their identities are linked to their wallet addresses. Using privacy-focused coins or techniques can help, but it's important to understand the level of privacy your chosen cryptocurrency provides. Cryptocurrency networks can be targeted by various attacks, such as 51% attacks, where a single entity gains control of the majority of the network's mining power. These attacks can disrupt transactions, double-spend coins, or undermine trust in the currency. While major cryptocurrencies are generally secure, smaller coins may be more vulnerable. Understanding network security is important for assessing risk. Fast pace of innovation in the crypto space means that some coins or technologies can become obsolete quickly. Projects that fail to keep up with technological advances or lose community support may fade away, leaving investors with worthless assets. Before investing, consider the long-term viability and adaptability of the cryptocurrency. Hype and speculation can drive up the price of cryptocurrencies beyond their real value. Overhyped projects often attract investors with big promises but deliver little substance. When the hype fades, prices can crash, leaving latecomers with losses. Always look beyond marketing and evaluate the fundamentals of any project before investing. Volatile nature of cryptocurrencies can lead to emotional decision-making. Fear of missing out, FOMO, or panic selling during downturns can result in poor investment choices. Developing a clear strategy and sticking to it, regardless of market swings, is key to avoiding emotional pitfalls. Take time to plan your investments and avoid making decisions based on hype or fear. Like traditional bank accounts, most cryptocurrency holdings are not insured. If your funds are lost due to hacking, fraud, or exchange failure, there's usually no way to recover them. This lack of insurance increases the risk for investors and highlights the importance of personal security measures. Consider using hardware wallets and spreading your assets across multiple platforms. Some cryptocurrency projects have vague or constantly changing roadmaps. This lack of clarity can make it hard to judge the project's direction or potential for success. Projects with clear, achievable milestones and transparent communication are generally more trustworthy. Always review a project's roadmap and progress before investing. Cryptocurrencies require internet access for transactions and management. In areas with unreliable internet or during outages, accessing your funds can be difficult or impossible. This dependency is a unique risk compared to traditional assets. Always consider your access to reliable internet when managing crypto assets. Partnerships can add credibility to a cryptocurrency project, but unstable or fake partnerships are a risk. Some projects exaggerate or fabricate partnerships to attract investors. Always verify partnership claims through official announcements and reputable sources before making investment decisions. Participating in certain crypto activities such as unregistered securities offerings or illegal transactions can expose users to legal liability. Laws are still evolving, and what is legal today may not be tomorrow. Always ensure your activities comply with local regulations and seek legal advice if unsure. Transaction fees on cryptocurrency networks can be unpredictable, especially during periods of high demand. Sudden spikes in fees can make transactions expensive or even unfeasible for small amounts. Always check current fees before sending transactions and consider the impact on your investment strategy. Despite growing popularity, cryptocurrencies are still not widely accepted for everyday purchases. Limited acceptance can restrict the usefulness of your holdings and make it harder to spend or convert them. Before investing, consider how and where you can use your chosen cryptocurrency. Value of cryptocurrencies can fluctuate wildly, even within a single day. This instability makes them risky as a store of value or medium of exchange. Price swings can be triggered by news, rumors, or market sentiment. Always be prepared for volatility and avoid investing more than you can afford to lose. Customer support in the crypto industry can be lacking, especially on smaller platforms. If you encounter issues with transactions or account access, getting help may be difficult or slow. Choose platforms with a reputation for responsive support and clear communication to minimize frustration. Some cryptocurrencies have unclear or disputed ownership, which can lead to conflicts and instability. Projects with anonymous or hidden founders may lack accountability. Before investing, research the team and ownership structure to ensure transparency and trustworthiness. Recovering lost or stolen cryptocurrency can be extremely complex, if not impossible. There are no central authorities to assist, and the decentralized nature of blockchain makes tracking funds difficult. Always take proactive steps to secure your assets and understand the recovery options available for your chosen wallets and platforms. Social engineering attacks target users by manipulating them into revealing sensitive information. Scammers may pose as support staff, friends, or trusted contacts to gain access to your accounts. Always verify identities and never share private keys or passwords with anyone, no matter how convincing they seem. As we've seen, the world of cryptocurrency is filled with both opportunities and significant risks. From market volatility and security threats to regulatory uncertainty and technical challenges, it's essential to approach crypto with caution and awareness. Always do your own research, use strong security practices, and never invest more than you can afford to lose. By understanding the risks and taking proactive steps, you can better protect yourself and make informed decisions in the fast-evolving world of digital assets.